Hey everyone, it is good to be here again, just chatting with you all. Today I want to talk about something that hits really close to home for me, something that cost me a lot of sleepless nights and, honestly, a lot of the money I had painstakingly saved up. We are going to dive into the housing market, but not from the perspective of some financial guru telling you what to do. No, this is from the perspective of someone who has been there, made the mistakes, and paid the price. I want to share my story, the lessons I learned the hard way, and hopefully give you some pointers so you do not fall into the same traps I did. When I was in my early 20s, I was eager, impatient, and frankly a bit naive about money. I saw friends and acquaintances seemingly making a quick buck in real estate, and I thought, why not me? I mean, who would not want to get rich fast, right? I heard all the buzz, the whispers about hot properties, and the promise of astronomical returns. It felt like everyone around me was making money hand over fist, and I did not want to be left behind. This was my first big mistake, chasing the hype. I jumped in, fueled by a desire for quick wealth and absolutely no real understanding of how the market worked. I was chasing shadows, believing that if I just bought what everyone else was buying, I would automatically succeed. It turns out that is a recipe for disaster. I remember thinking that real estate was this magical pathway to riches. I heard about people flipping houses, making huge profits in months, and I wanted a piece of that action. My family background was pretty ordinary, so I did not have a safety net, nor did I have anyone experienced to guide me through the complexities of property investment. I relied on snippets of information, often from unreliable sources, and my own misguided optimism. I thought I was smart enough to figure it out, but I was not. I was just throwing darts in the dark, hoping one would stick. One of my biggest blunders was getting involved in short-term speculation. I would buy properties, sometimes with borrowed money, fully expecting to sell them quickly for a much higher price. I was always looking for the next big thing, the next undervalued gem, the next trend to ride. I convinced myself that I had a keen eye for potential when in reality I was just gambling. I would pour money into properties, often without proper due diligence because I was so convinced that the market would always go up. I bought into the idea that real estate was a one-way street to profit, a belief that eventually led me straight into a financial dead end. I remember one particular instance. I bought a property, feeling incredibly confident it would soar in value within months. I put a significant portion of my savings into it along with a loan, which in hindsight was far too much for my financial situation. I did not have a clear exit strategy, nor did I have any contingency plans if things went south. I was operating on pure emotion and wishful thinking. The market, as it often does, had other plans. It did not go up as fast as I expected, and then it started to dip. I held on, hoping for a rebound, but it never came, not in the time frame I needed. I ended up selling at a substantial loss just to cut my losses and avoid further debt. That experience was a punch to the gut, a very expensive lesson in the volatility of markets and the dangers of speculation. Another hard lesson was trusting people too easily. In my eagerness to succeed, I was susceptible to smooth talkers and promises of guaranteed high returns. I fell for a few schemes that, in retrospect, had all the red flags waving furiously. These were not sophisticated operations, but at the time, my desire for quick money blinded me to the obvious signs of a scam. I lost money to individuals who promised me insider deals and incredible profits, only to disappear with my cash. It was a painful realization that not everyone in the investment world has your best interests at heart. It taught me to be incredibly skeptical, to always do my own research, and to never ever put money into something I do not fully understand, especially if it sounds too good to be true. My lack of risk management was also a huge problem. I would go all in, putting all my eggs in one basket, often using leverage that I could not comfortably afford. I did not understand the concept of diversification, nor did I appreciate the importance of having a robust emergency fund. I thought that if I believed in an investment enough, it would just work out. This emotional approach to investing was a disaster. When the market turned, I had no buffer, no way to absorb the shock. I was overexposed and vulnerable, and it cost me dearly. Heavy allocation to a single asset class without considering the downside was a rookie mistake, one that many young investors make, and one that I hope my story helps you avoid. The worst part about all these experiences was the emotional toll they took. I would ride the highs of a small win, feeling invincible, only to crash hard when an investment went south. This cycle of euphoria and despair was exhausting. I would constantly check prices, obsess over market news, and let my mood be dictated by my portfolio's performance. It was a miserable way to live, and it taught me that emotional trading is a losing game. You cannot make rational decisions when your emotions are running wild. You need a clear head, a solid plan, and the discipline to stick to it, regardless of market fluctuations. After losing a significant chunk of my hard-earned savings, I had a rude awakening. I realized that my approach to investing was completely wrong. I was chasing fantasies, not building wealth. It was a difficult period, but it also became a turning point. I decided to stop listening to the noise, stop chasing the hype, and start educating myself properly. I devoured devoured books, articles, and reputable financial resources. I learned about long-term investing, diversification, risk management, and the power of compounding. I learned that slow and steady often wins the race, especially in investing. Now, my approach is completely different. I am no longer interested in getting rich quick. I am focused on building a secure financial future through steady, low-risk investments. I prioritize saving, building an emergency fund, and understanding every single investment I make. I am wary of anything that promises exorbitant returns and always scrutinize any investment opportunity with a healthy dose of skepticism. My experience taught me that humility is crucial in the world of finance. It is okay not to know everything, but it is not okay to pretend you do. So what about the current housing market, you ask? Well, let me tell you what I am seeing and why it reminds me a bit of my own past mistakes. Though on a much larger scale, we are hearing about negative equity, which for those who might not know, means you owe more on your house than it is worth. It is a tough situation and it is becoming more common. I remember this term from when I first started out in real estate. Back in 2008, it was everywhere then. Now, it seems to be making a comeback in certain areas. Imagine buying a house, thinking it is an asset, only to find out it is a liability because its value has dropped. It is a painful realization, and for many, it means they are stuck. Or if they have to sell, they are selling at a loss. And it is not just the value dropping. The interest rates are making things even more complicated. People who bought recently with low interest rates might be fine, but new buyers are facing much higher rates. This means the monthly payments are significantly higher, making it harder for them to afford the same houses. This creates a disconnect. Sellers want to get their money back, especially with commissions and closing costs, but buyers cannot afford the prices needed for sellers to break even. This leads to a stagnant market in many areas where transactions are difficult to complete. I also noticed this interesting dynamic where older generations, particularly baby boomers, seem to be dominating the housing market right now, both as buyers and sellers. My theory, and it is just a theory based on what I observe, is that many of these individuals have accumulated significant assets over the years, often through the stock market. With the stock market reaching new highs, many are feeling confident and might be cashing out some of those gains to invest in real estate. They are not as sensitive to higher interest rates because they are coming in with substantial capital. This creates a very bifurcated market. On one hand, you have the entry-level market where younger buyers like those from Gen Z and younger millennials are struggling immensely. Rising prices, inflation, and higher interest rates are hitting them hard. They do not have the accumulated wealth to easily navigate this environment for them. Every percentage point increase in mortgage rates can be the difference between qualifying for a house or not. It is a tough hand they have been dealt. Then on the other hand, you have the luxury market where I am seeing a lot of activity in places like Las Vegas, for example. Properties valued at $5 million and above are seeing a lot of traction. These are often cash deals, or deals where buyers are not heavily reliant on mortgages. I believe these buyers are often those who have done extremely well in the stock market, especially with tech companies or industries experiencing rapid growth. They are trimming their stock portfolios and pouring that money into high-end real estate. This situation, while seemingly good for those with assets, makes it incredibly challenging for the average person trying to enter the housing market or move up. It feels like the rich are getting richer and everyone else is struggling to keep up. It is a stark reminder that economic conditions can create very different realities for different segments of the population. I also want to touch upon the broader economy and how it ties into all of this. The stock market, despite all the concerns, has been on an incredible run. We hear about PE ratios and indicators, and some suggest that while things seem expensive by historical standards, it might just be a new normal. The digital economy, AI, and a truly global marketplace mean that the old metrics might not fully capture the current reality. It is a complex picture, and it is easy to get lost in the numbers. However, the easy money in the stock market for some means that they have the means to make significant moves in other asset classes. Like real estate, this influx of capital from stock market gains into real estate is creating a dynamic where the average buyer is increasingly disadvantaged. They are competing against individuals who have a massive financial advantage, making it difficult to secure properties, especially in desirable areas. My personal journey has taught me to be very cautious and to always look beyond the headlines. When I see these trends, I remember my own eagerness to jump into things without fully understanding the underlying dynamics. It reinforces my belief that for most of us, especially those without a massive financial cushion, a measured, informed, and patient approach to investing is the only sensible way forward. Do not get caught up in the hype, do not blindly follow the crowd, and always do your own research. It is about understanding your own financial situation, setting realistic goals, and making decisions that are aligned with your long-term well-being. Not just short-term gains. It is a slow and steady climb, not a sprint. And believe me, from someone who has tried the sprint and fallen flat on his face, the slow and steady approach is far less painful and much more sustainable. I also believe it is important to be mindful of broader economic trends, even those that seem unrelated. Take travel. For instance, it might seem like a small thing, but when people start cutting back on travel, It is often a sign that things are getting tight financially for many households. Conversely, when travel picks up, it can signal renewed consumer confidence. These seemingly minor indicators can provide clues about the overall health of the economy and consumer sentiment. It is all connected. My main message today is this: learn from my mistakes. Do not be swayed by the promise of quick riches. Do not invest in things you do not understand. Do not take on more risk than you can comfortably bear. And certainly do not let your emotions dictate your financial decisions. Building wealth is a marathon, not a sprint, and it requires discipline, patience, and continuous learning. I am still learning every day, and I am committed to sharing what I learn, especially the hard-won lessons from my own investment blunders. My hope is that my experiences can serve as a cautionary tale, helping you avoid the pitfalls I encountered. It is about equipping you with the knowledge and mindset to make smart financial choices, choices that lead to stability and long-term prosperity, not just fleeting gains. So, take a step back, assess your own situation, and make informed decisions. It is not about being a financial wizard. It is about being a sensible and diligent investor. That is the kind of advice I wish I had listened to when I was younger, and it is the kind of advice I want to share with all of you. Thank you for listening to my unfiltered thoughts today. I appreciate you being here. If you have any thoughts or questions, please leave them in the comments below. I try my best to read and reply to as many of you as I can. It is always great to hear your perspectives. And hey, if you found this helpful, consider giving it a thumbs up and subscribing. It really helps me out. Until next time, take care.